Welcome to Iron Financial, the place where we help you forge a stronger portfolio and cut right through all that market weakness. Today, we are putting Petco, ticker symbol WOOF, directly under the microscope. Now, this is a company that is truly in the crucible. The market has absolutely hammered the stock, yet at the same time, management is posting numbers that just scream operational turnaround. So we're here to do what we do best. Stress test this company's entire structure and figure out, once and for all, if they're building a fortress or just a facade.
And that's really the core conflict, isn't it? It's this total disconnect. On one hand, you listen to the C-suite on their earnings call, and they're talking about a strengthened foundation, a brand new economic model. But then on the other hand, you just look at a stock chart that looks like a lead balloon, and you see sales numbers that are pointing in the completely wrong direction. So the question for every single investor looking at this is simple. Are you looking at a deep value opportunity, a company that is truly reforging itself from the ground up? Or is this just a classic value trap, a house of cards that's maybe one stiff economic breeze away from totally collapsing?
Exactly. And to answer that, we're running Petco through our 5-part Iron Financial stress test. First, we're going to look at management's actual blueprint for this turnaround. Second, we'll dive in and analyze how they are forging these impressive profits from what is, let's be honest, a painful sales environment. Third, we're going to examine the cracks in that top-line revenue. Fourth, we will assess the sheer weight of their debt load. And finally, we'll deliver our iron verdict. All right, let's fire up the forge.
Okay, before we even touch the numbers, you have to understand the strategy. You just can't look at a profit number in a vacuum, in isolation. You have to understand the plan that actually produced it. Petco's management, led by CEO Joel Anderson, has been really clear that none of this is random. It is a deliberate, multi-phase operational reset. They knew they had to fix the engine before they could even think about trying to win the race.
And here is that plan, laid out for everyone to see. Phases 1 and 2, which they tackled all throughout 2025, that was the dirty work. We're talking optimizing inventory, slashing costs, and strengthening the core of the business. Now, here in 2026, they claim to be in Phase 3, which they've kind of dramatically called Reach for the Sky. This is the big pivot back to growth. The heavy lifting is supposedly done. Now they have to prove that this leaner, more resilient structure can actually go out and win that race.
And that's a very confident quote from the CEO. But confidence doesn't pay the bills, does it? He says the foundation is firmly in place. Well, my job here is to question that. How firm is it really? Is it built on solid bedrock, or is it just a thin slab of concrete that they poured over sand? Because let me tell you, if that foundation isn't as strong as he claims it is, then this whole reach for the sky growth phase is going to come crashing down under its own weight. So enough talk. Let's see the proof. Let's see the numbers. All right, this is where the bull case really begins. Let's start the stress test by looking at the steel they've actually forged on the bottom line. I mean, regardless of what you think about their sales, and we'll get to that, the improvements in profitability and cash flow are just undeniable. This is the direct result of that operational reset we just talked about. And the numbers, frankly, they're staggering. This is the heavy lifting in action. Yeah, forget about minor improvements. This is a fundamental, seismic shift in the cash-generating power of this business. Full-year free cash flow absolutely exploded, from under $50 million to $187 million. That's a 276% increase. This right here, this is the lifeblood that pays down debt, that funds growth, and builds a fortress against any economic downturn. For a company that was being questioned on its very survival not that long ago, generating this kind of cash proves the turnaround isn't just talk. This is pure, unadulterated operational discipline right on the page.
Okay, a 190 basis point expansion in operating margin for the full year is impressive. I'll give them that. The CFO, Sabrina Simmons, she calls this their economic model, and you can really see it working here. What this means, in plain English, is that for every single dollar of pet food or services they sell, they are keeping almost 2 cents more as operating profit than they were just a year ago. That is a huge efficiency gain. But the question that immediately pops into my head is, where did it come from? And more importantly, is it sustainable?
That's a fair question, and this chart helps to answer it. See, this wasn't some one-time accounting trick. Look at the core earnings. Full-year adjusted EBITDA, and for those of you at home, that's just earnings before interest, taxes, depreciation, and amortization. It's up over 21%. It jumped from $336 million to over $408 million. Think of this as the engine of the business, and right now it's running hotter and way more efficiently than it has in a long time. This is the tangible result of their turnaround plan. It's real, it's measurable, and it directly powered that massive cash flow we just saw a second ago.
Okay, so this slide really breaks it down for us.
They expanded their gross margins, which means they either got better pricing or they got a tighter grip on their product costs. They leveraged SG&A, which is just a fancy way of saying they cut corporate and store-level overhead. And a huge piece of this puzzle was inventory management. Getting inventory down by nearly 10% is just massive for cash flow. But this last point is the one that really worries me. Made a disciplined exit from unprofitable sales. It sounds great. It sounds smart, but there's a fine line between cutting fat and cutting muscle. Did they just get rid of some low-margin junk? Or did they start cutting products and services that, maybe they were less profitable, but they were the things bringing customers in the door? That is the billion-dollar question that leads us right to the cracks in this story.
And here we are. This is the heart of the bear case. I mean, for all the talk of operational excellence and forged profits, a business simply cannot shrink forever. At some point, you have to sell more stuff. The saying, revenue is vanity, profit is sanity, is true, but only to a point. If revenue continues to decay, sanity eventually follows it right out the door. The market is looking at these next slides and seeing some really serious structural cracks.
Let's just start with this number right here. In the fourth quarter, net sales were down 2.4%. This is the headline figure that spooks investors. While the company is out there celebrating a 21% jump in EBITDA, the market sees a 2.4% decline in the top line, and it gets, understandably, very nervous. This directly challenges that positive profitability story because it suggests the profit was manufactured simply by cutting, not by actually growing, and you can only cut so far.
I think it's important to add some context here, though. That net sales number, it includes the impact of them closing 16 underperforming stores during the year. The comparable sales number, which only looks at stores that have been open for at least a year, was down a little bit less, at 1.6%. But your point absolutely stands. Both numbers are negative. The big question is why they are negative.
Right. And is it a temporary dip, or is this the beginning of a long-term trend? A negative comp sales number, that suggests a fundamental issue. It means that, on average, your existing stores are selling less than they were a year ago. That could mean fewer customers are walking in the door, or the customers who do show up are spending less money. Neither of those is a good sign for a growth story.
And these concerns are not new. This isn't something that just appeared out of thin air last quarter. Just look at this report from West Peak Research all the way back in 2023. They were already asking if the company was all bark, no bite. They highlighted the fierce external competition from the big box retailers, your Walmarts and your Targets, as well as the e-commerce giants. Well, those pressures haven't gone away. If anything, in a tough economy, they get even worse as consumers start looking for the absolute lowest price, not necessarily the specialty experience. Okay, but this is management's counterargument, and it's an absolutely crucial point to understand. They argue this sales decline was not a failure, it was a choice. It was the direct and totally expected result of Phase 1 and Phase 2 of their turnaround. They intentionally walked away from certain sales because they were just unprofitable. They closed stores that were bleeding cash. Their argument is that they've surgically removed the unhealthy parts of the business to create a stronger, more profitable core from which to finally grow. This wasn't decay, it was a controlled demolition to make way for a much stronger structure.
I hear the argument, and it's a plausible story, it really is. But talk is cheap. The ultimate test of whether that controlled demolition actually worked is the blueprint for the new building. The forward-looking guidance for 2026, that's where the rubber really meets the road. Does it show a business that's poised to rebound and start building again? Or does it just show a business that's stabilized at a much lower level? Let's take a look at the forecast.
And the guidance shows the pivot. They're guiding for net sales to be anywhere from flat to up 1.5%. And crucially, they expect comparable sales to be positive for the full year. That means they believe the bleeding in their core stores has finally stopped and is about to reverse. And just look at the EBITDA. They expect it to continue growing from that $408 million last year to a range of $415 to $430 million. To me, this shows the plan is on track. They've reset the base and are now forecasting a return to growth, but on a much more profitable foundation. I see a different picture. I see a pretty anemic top-line forecast. Flat to plus 1.5% is hardly reaching for the sky. That's barely keeping up with inflation, if it's keeping up at all. And expected to be positive for comps is so vague. Is that 0.1% or is it 3%? It feels like they've done all of this painful cutting just to get back to flat. It doesn't exactly scream that a powerful new growth engine has been built. It feels fragile.
That's a fair criticism of the top-line guidance, I'll admit, but a company's structural integrity isn't just about its growth prospects. It's about the foundation. It's about the balance sheet. A fragile growth story can actually survive if the foundation is solid rock, but a booming growth story can collapse overnight if it's built on a mountain of debt. So let's shift our focus to the balance sheet, which has been another area of some major heavy lifting for Petco.
This slide right here, this might be the single biggest testament to their financial turnaround. A year ago, their leverage ratio, which is just their total net debt compared to their annual EBITDA, was at a dangerously high 4.2 times. In just 1 year, they have brought that all the way down to 3.0 times. This is a massive improvement. It takes them out of the immediate danger zone and gives them significant breathing room. They fundamentally de-risked the company. This is a stronger, more resilient foundation than it was just 12 months ago. Period.
And again, this didn't just happen by accident. This was a deliberate playbook. They took that massive free cash flow they generated and they used it to make a $95 million voluntary debt payment. That is a huge sign of confidence. They also proactively refinanced their remaining debt, pushing the due dates way out to 2031, which completely removes any near-term solvency risk from the table. And of course, growing the EBITDA in the denominator of that ratio helped bring it all down as well. Every single step was a calculated move to strengthen that balance sheet.
I see the CFO's quote, and I want to focus on the second half of it, while continuing to navigate a bumpy macro backdrop. She is acknowledging the risk right there. Yes, going from 4.2 times leverage down to 3.x is a great accomplishment. It's a huge step in the right direction, no one's denying that. But 3.x is still a significant debt load. It's not trivial. In a strong economy with sales that are growing, 3.x is perfectly manageable. But in a bumpy macro backdrop, with a consumer who is pulling back on discretionary spending, a 3.x debt load can still feel very, very heavy. If that weak revenue guidance comes in even weaker than they expect, that leverage ratio could tick right back up very, very quickly. The foundation is stronger? Yes, but I'm not convinced it's earthquake-proof just yet.
All right, that brings us to the end of our stress test. We've examined the blueprint, we've looked at the profitability, the revenue cracks, and the debt foundation. So now it's time to weigh all the evidence and deliver the iron verdict. Is this stock a coiled spring, an opportunity that's been forged in the fire of a turnaround? Or is it a trap, just waiting for the next economic shock to expose all of its weaknesses?
So let's summarize the structural integrity report. The steal in this company, the profit engine, that part is real. You simply cannot fake a 276% increase in free cash flow or a 190 basis point margin expansion. That is tangible, hard evidence of a well-executed operational fix. But the cracks are just as real. The revenue story is completely 100% unproven. They have successfully shrunk the business to make it more profitable. Great. Now they have to prove they can make that smaller, more profitable business actually grow again. That reach for the sky phase is a promise, not a reality yet. And that brings us to the foundation. The balance sheet is undeniably stronger. They have more flexibility, less near-term risk. But that 3.0x debt load is the fulcrum on which this entire story balances. It's the key risk factor that magnifies both the potential reward and the potential for failure, especially in the bumpy economy the CFO herself mentioned. It's a classic story of proven operational strength versus completely unproven top-line growth.
So, it all comes down to this. This is the crucial question for anyone looking at this stock. Do you believe in this management team? Do you believe they have the right strategy, the right products, and the right services to execute Phase 3 and actually reignite top-line growth? And critically, do you believe they can do it before a potential recession or a serious pullback in consumer spending, that bumpy macro backdrop, puts too much pressure on their still leveraged foundation? The engine has been rebuilt, the foundation has been reinforced, but the race is just beginning, and the weather looks very uncertain. That's the gamble in Petco today. It's up to you to decide if it belongs in your portfolio. Thanks for joining us at Iron Financial, where we help you forge a stronger one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.